Hi, good evening all. Welcome to a wonderful session organized by Hyderabad Chartered Accountants Society. And I welcome all the participants for this wonderful event and have a good evening and a good learning session. And I'm happy to introduce Mr. Prashant Jain from Samisti Legal as a speaker. And thanks, Prashant, for your time. And Mr. Raman Heda from RVKS and Associates. And Mr. Mastan Ali, who is taking care of organizing this total event, helping us in the process. A few instructions before starting the meeting, introducing the speakers and starting the meeting. Mr. Organizer will take the lead for the any question and answers, and all the question and answers what been raised by the participants will be read out for the speakers, and the speakers will answer one by one once the topic respective topic is done. And if any persons want to specifically talk to the speakers, you can raise your hand, and based on that, organizer can enable you to unmute your microphone, and you can unmute your microphone and talk to the speaker. And let me take this opportunity to welcome all you on HCAS. And Mastan, I request to introduce Mr. Prashant Jain and Mr. Raman Heda for this gathering.
Thank you for the warm welcome, sir. Good evening, everyone. I am Mastan and I will be your host for today's evening session. It's my honor to introduce our esteemed speakers for today, Mr. Prashant Jain and Mr. Raman Heda. First, we have Mr. Prashant Jain. Prashant is the founder and managing partner of Samisti Legal, a boutique corporate and commercial law firm based in Hyderabad with offices in Mumbai and Bangalore. His primary focus is on private equity and venture capital transactions, debt transactions, startup and angel fundings, FPI investments, SEBI regulations, FEMA, RBI registrations, fund setups, NBFC registrations, acquisitions, structured debts, MBOs and IPOs, and various business restructurings in the field of M&A. He also handles matter related to company law, corporate and commercial laws, FEMA, cross-border investments, and capital markets. He has a strong track record in handling high-profile VCP transactions, LBOs, MBOs, IPOs, and complex corporate litigations, including insolvency cases. Prashant's expertise extends to drafting, reviewing, and advising on a wide range of transaction and commercial documents across various industries, including infrastructure, IT, media, life sciences, and consumer retail. He also represents clients in M&A, corporate litigation, and enforcement matters. Over the past 16 years, he has worked on approximately 350 transactions involving over 100 billion INR in investments. He is qualified advocate enrolled with the Bar Council of Telangana, a company secretary recognized by the Institute of Company Secretaries of India, and has been recognized as one of the top 50 corporate dealmakers for the financial year 18-19 by Legally India. Samisti Legal has consistently been ranked among the top 50 law firms in India by Legally India. And Venture Intelligence has been noted as a notable firm in the corporate and M&A category for the years 21 and 22. In 2023, Samisti Legal was recognized as a Tier 1 law firm in Hyderabad, and Prashant was recognized as a leading individual in the corporate M&A category by Legal 500. So now it's my pleasure to introduce our next speaker, Mr. Raman Heda. Mr. Raman Heda is a partner at RVKS and Associates, a chartered accountant with a strong background in corporate advisory, regulatory compliance, and financial strategy. A commerce graduate from Usmania University, Hyderabad, he qualified as a chartered accountant in 2017 and began his professional journey with the firm in 2014. He specializes in virtual CFO services, corporate advisory, and labor law compliances. He has a significant experience advising both Indian and foreign clients on matters under FEMA, including FDI, ODI, and RBI compliance requirements such as FCGPR, FCTRS, FLA, and APR returns. He also been actively involved in advising HNIs on tracking their net worth via dashboards and governance. He completed the certificate course on trusted advisors to family business conducted by the ICI, further strengthening his expertise in the family office and wealth advisory space. He also plays a key role in financial due diligence, share valuation, internal audits, and supports clients with MIS reporting and SOPs development. His comprehensive understanding of regulatory frameworks and financial systems enables him to deliver integrated and practical solutions tailored to startups, MSMEs, and emerging business. Now let us all invite both the speakers, Mr. Prashant Jain and Mr. Raman Heda, to take us through the session. Thank you, sir.
Thank you, Mastan Wali, for the warm introduction. Let me quickly share my screen and yeah. Mastan, once the screen is visible, let me know.
Sir, your screen is visible.
Thank you. Thank you for the confirmation. So before beginning, thank you, HCAS, for inviting us to present on this topic of navigating investments, FDI and ODI under FEMA. Friends, today cross-border investments isn't just the concerns of MNCs also, even startups, family businesses, mid-sized companies are opening up to international markets. Okay, whether you are a student stepping into the field or if you're a seasoned practitioner, you'll be advising clients making corporate acquisitions, filing FCGPRs, certifying valuations, or whether preparing compliance reports. FDI, ODI, these are just no longer niche market. They are the front line of economic expansion and also where the biggest penalties for the non-compliance can hit. With that context, let us set the stage with the story that I have prepared. Now you might be thinking that why this casino, the image of this casino is being displayed, but let me try to set the context with this image. Let's say you walk into a casino, you have 10,000 rupees, and against which you receive the chips from the casino. You start playing it. Some win, some lose, but there's one rule: you cannot take the chips home. Now, these chips are not money outside the casino. You have to encash them before you leave. That's how the foreign currency works in India. We allow it, but with a rule book. Whether bring it in as an investment, that is fine. But how do you use it? How that needs to be declared, or what needs to be done when your investment is completed, whether you repatriate it or surrender it. These all needs to be reported. This is the core of FEMA and the basis under which you will have to understand the FDI or ODI regulations. Moving on, some ground rules that want to set up before we get into the core of FEMA under FDI and ODI. Now, when it comes to FEMA compliance, our filings are generally not just routine paperwork. They are the final reflection of how well you have understood the transaction. If you have misinterpreted the FEMA provisions or missed a step, it just shows up there in the form of defects or delays or even in terms of penalties. Now, before we talk about FCGPRs, ODI, or APRs, the fundamental question is, why are you filing all these? Each form has a regulatory purpose. Now, some are event-based, some are annual. The goal is to build awareness, knowing exactly what needs to be filed, when it needs to be filed, and why. Because learning FEMA is not just about reading circulars, it's about navigating the RBI portals, emails, interpreting which is not always clearly written in the law. How are we going to do it? We are going to see certain real screenshots that have been taken from the portal, the use cases, and we'll try to discuss about what all practical scenarios you can face. Now, quick disclaimer, these FEMA filings are are not always black and white. Whatever we are going to share is generally will be based on the practical experience. So to keep in mind, RBI or AD banks sometimes interpret things differently. So don't treat this session as a rule book or something like that. Instead, you can take it as a starting point and pair it with client specific facts or wherever needed with professional judgment. Now, when you come into FEMA, the first question which comes to mind is, what do I start with respect to FDI that I'm talking about? What do I read? Where do I begin? Now, to understand that, we have tried to list out the provisions that can be taken as a starting point. First, starting with the authority which has issued the provisions, which is Ministry of Finance. The provision is FEMA NDI rules, which is non-debt instrument rules 2019. This being the core legislation for the foreign investment of in equity instruments. Second, FEMA mode of payment and reporting of NDI regulations 2019 issued by RBI. This will talk about the reporting timeline, payment mode, valuation basis, stuff. Next is for master directions on foreign investment in India by RBI, which will act as a operational guidance for the provisions that are there. Next, we have master direction issued by RBI, which is a consolidated guide on reporting obligations. Then you have consolidated FDI policy issued by DPIIT, this Department for Promotion of Industry and Internal Trade, which will talk about sectoral caps, automatic or approval routes, press notes. Then you have DPIIT and DEA, which is Department of Economic Affairs, which have issued the SOPs, which will talk about the approval process for sectors under approval route. Then you have firms portal manuals and the SOPs issued by RBI, which will act as a practical user level guides for filing of the forms which are available online. Then you have the NIC codes and the press notes issued by DPIIT for the sector classification.
Mr. Raman, there is a echo and clarity is missing. Can you check your microphone, please? What about others? Can you please chat?
Yeah. Is it better now?
Yes, sir. Your voice is better now.
Okay. Right. Then I'll continue.
Okay.
Now, moving with the strategy. Now, how do I start and where do I start? Let's say a client has come in. He's asking for a incorporation of a company. Where do I start? What is the first step? Now, first, we'll go through the DPIIT FDI policy circular and the press notes to understand whether the sectoral route is automatic, or there are government restrictions in it, or is it under a prohibited sector? Second, I'll try to understand through the FEMA NDI rules whether what is the basis, legal basis for the equity instruments, downstream investments, and valuations. Third, RBI master directions for the operational steps, the form-wise procedures, and the guidelines. Next will be SOPs and the firm manual for the practical execution and the filing. A tip, there is a Prava portal issued by RBI wherein the approvals can be obtained with respect to the compliances that are there, where RBI approval is required to be obtained. Second, you can track updates from both DPIIT and RBI with respect to the policy and the execution layers which are there. Now, before getting into what are the provisions under NDI or the filings that are there under FDI, there are certain key definitions that we wanted to discuss upon. First one being equity instruments. Equity instruments means the equity shares, convertible debentures, preference shares, and the share warrants that are issued by an Indian company. Now, you might have partly paid up shares or share warrants, which come under the equity instruments category or equity shares category. Partly paid up shares are those which have, if those have been issued to a person resident outside India, those shall be fully called upon within 12 months of such issue. 25% of the total consideration, including the share premium, shall be received upfront. This is the language that is there in the NDI rules 2019. In case of share warrants, at least 25% of the consideration shall be received upfront and balance amount within 18 months of the issuance of such share warrants. Foreign investment. Foreign investment means any investment made by a person resident outside India on a repatriable basis in equity instruments of an Indian company or capital of an LLP. Now, you might be thinking what is repatriable and what is non-repatriable. We try to cover up a separate slide talking about the differences which are there between repatriable and non-repatriable investments. NRI, non-resident Indian, means an individual resident outside India who is a citizen of India. OCI, overseas citizen of India, means Indian individual resident outside India who is registered as an overseas citizen of India cardholder under Section 7 of Citizenship Act. Now, you might be seeing certain words or terms called foreign investment, foreign direct investment, or foreign portfolio investment. Let us try to understand what is foreign direct investment. Foreign direct investment, or FDI, means investment through equity instruments by a person resident outside India in an unlisted Indian company. I'll take a pause there. Now we are talking about foreign direct investment, which is investment through equity instruments. Equity instruments is something which we have discussed earlier, which includes shares, debentures, and all, by a person resident outside India in an unlisted Indian company. This is the first part. Or in 10% or more of the post-issue paid-up capital on a fully diluted basis of a listed Indian company. So in case of listed Indian company, it is 10% or more. In case of unlisted company, there is no limit prescribed, which means even 1% or below that as well will be called as foreign direct investment. In case an existing investment by a person resident outside India in equity instruments of a listed company falls below 10% of the post-issue paid-up capital, still the investment will be continued to be treated as FDI. What is foreign portfolio investment? Now, foreign portfolio investment means any investment made by a person resident outside India through the equity instruments where such investments is less than 10% of the post-issue paid-up capital on a fully diluted basis of a listed Indian company, or less than 10% of the paid-up capital of each such series of the equity instruments of a listed Indian company. This will be the key differentiation between foreign direct investment and foreign portfolio investment. What are sectoral caps? Sectoral cap means the maximum investment, including both foreign investment on a repatriation basis by a person resident outside India in equity and debt instruments, or capital of an LLP, as the case may be, and indirect foreign investment unless otherwise provided. Now, we'll talk about what is indirect investment, what is on a repatriation basis in the further slides to come. Let us look at some of the illustrative list in terms of the sectors which are there under the NDI rules. First one is the automatic route, wherein no prior government approval is needed. Sectors like IT, infrastructure, tourism, manufacturing, and even e-commerce come under this category. However, some of them like insurance, telecom, they are subject to certain sector specific regulations. Then next you have government route, which requires prior approval. Like for instance, you have print media, which is 26%. You have banking, public sector 20%, and private banking up to 74%. This is not the total list. We have tried to list out few of them for discussion purpose. Finally, you have the negative list. These are sectors where FDI is completely prohibited, like agriculture, atomic energy, lottery, chit funds, real estate, and all. Next, before moving to the next topics, which is about indirect investment by swap of shares, I would like Mr. Prashant to take up these topics and explain you in detail.
Raman, am I audible?
Yes.
Sir, Raman, can you put the next slide? I can only see the blank page. Okay, so I think what Raman explained was predominantly on the direct investment in terms of the foreign direct investment, but there is also a concept of downstream foreign investment. So maybe I'll take 5 minutes to explain you the difference between the direct investment and the downstream investment. In a direct investment, it's a no-brainer that if there is a Indian company which is receiving a foreign investment from an investor who is a person resident outside India. So person resident outside India, there is a definition under FAMA. Anybody who is not a person resident in India. It could be a foreign individual. It could be a foreign company. If they are investing into an Indian company, that is called as a foreign direct investment. And as I previously mentioned, you have two routes of investment. One is a direct investment. So directly a person resident outside India investing in an Indian company. That is a direct investment. So it's a no-brainer. As Raman mentioned, if you are falling under the sector where FDI is allowed, then you can bring that FDI into the Indian company. There are certain guidelines to it. You have to follow the pricing guidelines. You have to see whether the sector is eligible for FDI. And then after you get the FDI, you have to do certain reporting with RBI. So that's the direct investment route, which Raman mentioned. Now the concept which I want to basically take it up is an indirect foreign investment. So whatever is not direct, whether that will come under the indirect foreign investment, that is something which we need to check in terms of FEMA. So for example, I'll just maybe give you an example. You will be able to appreciate that better. So for example, if there is a Indian real estate company under the FDI guidelines, real estate is not eligible to get the FDI. If the company is in the business of buying and purchasing land, then that company cannot have any exposure in terms of FDI. There cannot be any person resident in outside India who can invest in a real estate business. That's prohibited. Now what happens is, if because that is prohibited, there are structures which were misused maybe prior to 2011, wherein companies used to basically incorporate an Indian company which used to get the FDI from foreign resident outside India, and they used to have a subsidiary below the Indian company. So the Indian company used to raise money from the person resident outside India, and that Indian company used to float a 100% subsidiary, and that 100% subsidiary basically used to do the prohibited business. So what is happening? The money is coming into the holdco, and that holdco is incorporating a subsidiary. At the subsidiary level, if there is no compliance required under the FEMA regulations, then that typically is basically not attracting FEMA regulations, right? Because you're getting money into the holdco, and then because the holdco is a resident entity that is investing in the downstream, then typically that was usually said to be allowed. That's why RBI came out with a downstream investment regulations, wherein they said if you are an Indian company which is controlled by a foreign, which is owned and controlled, which is not a Indian owned and controlled. So what is Indian owned and controlled? For example, if you have an Indian company wherein you have 51% shareholding of a domestic shareholder and 49% shareholding of a foreign investor, then that is an Indian owned and controlled company, because the majority of shareholding is with the domestic investor. It is not with the person resident outside India. In that case, whatever you do at the downstream level, if you incorporate a new company and that company becomes your subsidiary, you are doing any other business, you don't apply FEMA because you are an Indian owned and controlled company. So there is a definition under FEMA wherein they say there are three important conditions to make sure that you are an Indian owned and controlled company. If you are an Indian owned and controlled company, then you need not go below the holding company and check for the FEMA compliances. But if you are a foreign owned and controlled company, if you are not meeting the definition of qualifying as an Indian owned and controlled company, then you automatically become foreign owned and controlled company. And if you are a foreign owned and controlled company, then under FEMA at each level, you have to comply. You have to see which sector you are operating, whether it's allowed under FEMA or not. And there are certain reporting requirements. If you are allowed, you can put that money into the downstream companies, but you also have to do certain reportings. So I'll just give you the conditions which are required to comply for the domestic to qualify as a Indian owned and controlled company. One is the shareholding test. So if you are if a domestic shareholder is holding more than 50%, then you are an Indian owned and controlled company. Second condition is the right to appoint majority of directors. So when I say majority of directors, for example, if you have a foreign investor who is holding 26% in the company, you may meet the first condition. But if the foreign investor is given the right to appoint majority directors, even though he's holding 26%, if he's given the right to appoint majority of directors on the board, then that also strips the definition of Indian owned and controlled. So that condition also should satisfy. Third is the foreign investor, even though he's not holding more than 50%, even though he doesn't have a right to appoint majority of the board of directors, but he has special rights. What are special rights? If you see FEMA, you will not get the definition of special rights. They just say that they should not have any control on day-to-day business operations, and they should not have any control on over the management or policy decisions of the company. So that is specifically a condition which has to be tested, even though you are not stripping the definition of shareholding, even though you are not stripping the definition of appointing majority directors, this also has to be seen. So for the sake of clarity, maybe I will give you my experience in terms of what rights could strip the definition of Indian owned and controlled. For example, if you bring a external investor who's holding 10% in the company, in the shareholders agreement, if you're giving them certain special rights, what could be those special rights? The rights could be divided into two buckets. One, rights which are basically given for protection of the minority. If you are giving minority protection rights, wherein you say that if I do any capital raise, if the company is getting wound up, if the company is diversifying its business, if the company is hiring and firing KMPs, these are all minority protection rights. So you should not give any rights which are giving control to them in terms of management policy decision making. So we have to basically test from that angle. So whatever rights just now I mentioned are more from a minority protection, right? These rights can be given, but you should not say that, okay, you will have a right to control our bank accounts. You will have a right to basically inspect the operations of the company. These are all operating rights. So these kind of rights cannot be given, irrespective of whether they are holding 1% in the company. And if these rights are given, then that will strip the definition of Indian owned and controlled. As long as you are Indian owned and controlled, then the testing stops at the first level. The moment you strip the definition of Indian owned and controlled, then at each level, at your subsidiary level, we have to see and make sure that the FEMA compliances are done. So that's the whole concept of downstream investment. Maybe Dhawan, you can go to the next slide. I'll give them some understanding in terms of how do you compute the indirect foreign investment. So this is the structure. In my example, what I mentioned, non-resident entity is the person resident outside India. ICO1 is the Indian first level company. ICO2 is the Indian second level company. So this is the diagram which is basically giving you the flavor in terms of what is called as direct and what is called as indirect. If a non-resident entity is investing in ICO1, it's a direct investment for ICO1. And if the ICO1 is a Indian owned and controlled company, whatever ICO1 does in terms of investing in ICO2, that should not be seen because you are an Indian owned company and the testing stops at ICO1. But if the ICO1 is a foreign owned and controlled company, then the money which is going at the downstream level, which is ICO2 in this example, we need to see whether that sector is allowed in terms of FEMA regulations. When I say sector, for example, real estate is prohibited, right? Insurance has specific threshold. You cannot go beyond that. Then agriculture is prohibited. Then defense has certain restrictions. Then pharma has certain restrictions in terms of what is brownfield, how much percentage the money can come in brownfield, how much percentage the money can come in greenfield. Then retail, again, you have multi-level different businesses, right? It could be a single brand retail, it could be a multi-brand retail, it could be a marketplace like Amazon, Flipkart, right? So those conditions will apply. So at each level, you have to see whether that sector is allowed in terms of investment at the downstream level. Also, if you are a foreign owned and controlled company, right? Pricing guidelines will not apply because the money is a domestic money because the money has come from abroad, but whatever pricing guidelines are supposed to be followed at first level has been followed. There is a reporting requirement, which I will come in the next slide. So next slide, Raman. So in this example, if you see, non-resident entity is the entity which is investing in the first level company, which is 40%. And that 40% company, that first level company is investing and holding around 10% in the second level company. Now the question is whether the company has any indirect investment. In terms of my previous example, if I gave you three conditions, right? One, if your shareholding is more than 50%, if you have right to appoint majority directors, if you have any special rights. So in this diagram, if you see the first condition in terms of shareholding is not getting met, it says 40%. We are not going into the second condition because that's not given here. Assuming that the 40% shareholders are invested here doesn't have a right to appoint any majority directors, and he also doesn't have any special rights, then this diagram basically doesn't have any foreign direct investment, right? The second level testing is not required. Now in the second diagram, if you see, it's 51 and 10, correct? So because it is 51 and because that 51% entity which is having the non-resident entity as a foreign investor is investing below, which is 10%. And because you are 51%, the downstream investment company should also comply with FEMA. And one of the basic condition is the sector in which the downstream company is operating should be allowed under FEMA, right? So indirect foreign investment is 10%, correct? And direct foreign investment is 39%. So if you see in this diagram, non-resident entity is holding 39% directly in second level company, and there is an indirect foreign investment of 10%, which is through the first entity. So total foreign investment is 49%. In the third diagram also, if you see, 51% is held by the non-resident entity in the first level company. The second level company is holding around 100% in the first level company is holding 100% in the second level company. So the indirect foreign investment would be 51% because it's a mirror. Whatever is there in the first level company will get mirrored in the second level company. So this is the concept of downstream foreign investment. The whole concept is to make sure that whatever cannot be done directly should not be done indirectly. Whatever compliance has to be done for direct foreign investment should also be done for indirect foreign investment. Next, Raman. So maybe before moving to swap, one is basically in the downstream investment, I gave you a thesis in terms of what is called as indirect foreign investment. Then once you have basically categorized that yes, this investment which you are doing from an Indian company to the second level company is a foreign investment, then first we need to check the sector in which the underlying company is operating. Second, there are certain forms which have to be filed with RBI. The form is called DI form. At the first level company, you file form FCGPR. but at the second level company, you file DI form, which is called a downstream investment form. So that's the basic concept of downstream investment. Now, maybe I will also talk about the swap of shares. So under swap of shares, now, as Raman mentioned, when a company is getting FDI, there are certain compliances which have to be done, right? And typically when a company is getting FDI, it is in the form of cash. In swap of shares, there could be multi-level structures wherein the cash is not flowing. For example, if I'm a shareholder of a foreign company and I am holding shares in the foreign company, and you are a shareholder of an Indian company, you are holding shares in the Indian company, right? So you as an Indian company shareholder and I as a foreign company shareholder can swap shares, wherein I will say that I will surrender my foreign company shares in the favor of the resident who is holding the shares of the Indian company. And the resident who is holding shares of the Indian company may say that, okay, because you have surrendered your shares in the foreign company, I will surrender my Indian company shares. So basically it is nothing but a swap. This is one example. Second example, it could be the Indian company can get into an arrangement with a foreign company shareholder where they can say that you surrender your shares of the foreign company and I will issue shares of my company, right? So these could be typical structures where there is no cash consideration. It is all in the form of shares. So under FEMA, there are two guidelines. One is the foreign direct investment. Second is the overseas direct investment. So in swap, we have to see whether both these guidelines are getting triggered and if we need to do certain compliances under both the guidelines. So in my first example, I said the foreign company shareholder can surrender the shares of the foreign company and take the shares of the Indian company from a shareholder who's holding shares in the Indian company. So here what is happening? The foreign guy is getting shares of the Indian company and Indian guy is getting the shares of the foreign company. Because the foreign guy is getting the shares of the Indian company, we have to make sure that the Indian company in which he is getting shares is allowed to basically get a foreign investment. That sector should be allowed. Second, the foreign guy, the Indian guy who's getting shares of the foreign company, for him it becomes a ODI, right? For overseas direct investment, because he's an Indian guy and he's getting shares of the foreign company. So in that case, we have to see whether we also have to make, we have to also do the compliance in terms of ODI regulations. So maybe these kind of nuances you will get in a swap situations. You have to see which guidelines are getting triggered. In some of the transactions, only FDI may get triggered. In some of the transactions, both FDI and ODI may get triggered. So we have to see that the FDI guidelines in terms of sector, in terms of pricing guidelines are followed. And for ODI also, you have to make sure that the ODI guidelines in terms of what is the maximum limit of investment which a Indian guy can make in the foreign investment, whether that limit is in, whether that limit is there, but in which sector that foreign company is operating, because under ODI regulations also, if it's a financial sector, then there are different conditions, right? So that's this concept of swap. In this diagram, if you see on the PPT, existing structure where foreign company 1 and then you have foreign company 2, then you have Indian company, right? So here what is happening, the foreign company 1 holds shares in foreign company 2, and then Indian company, which is not in the structure, acquire the shares of foreign company 2 from foreign company 1. So here foreign company 1 is transferring the shares of foreign company 2 to the Indian company, and Indian company, which is basically the second example which I gave, the Indian company is giving its shares to the shareholder of foreign company 2 who has surrendered its shares in the foreign company 2. So here the resulting structure would be what? The resulting structure would be the foreign company 2 would become the, assuming that the foreign company 1 was the sole shareholder of foreign company 2, the foreign company 2 would eventually become the wholly owned subsidiary of the Indian company, right? So under the swap guidelines, if you see the FEMA regulations, there's no approval which is required with from RBI. Point number 1. Point number 2, whenever you are doing swap, both the entities shares have to be valued, wherein you have to appoint a merchant banker who would basically value both the companies, and then he will basically compute the swap ratio. If I am my value of my company is 100 crores, and if the value of the foreign company is 50 crores, right? Then I get, if I'm surrendering say 10% of my company, then I get 20% of the foreign company, because my value is 100 and the foreign company value is 50. So I get 1:2. So if I'm surrendering 10% of my company, I get double of it. So that's how the swap ratio gets computed, wherein a merchant banker will compute the swap ratio, and basis the swap ratio, you can basically swap the shares. And because you have swapped the shares, whatever reporting requirement under FDI, ODI, both have to be done. Next, Raman. Yeah, so swap, I think you would have understood. Downstream investment, you understood. Now coming to a basic concept under FEMA, repatriation basis and non-repatriation basis. So what is repatriation basis? If you understand that, then it would be easy for you to understand what is non-repatriation basis. Repatriation basis is nothing but any investor who is investing in India through a foreign currency, then they have a right to take that money out whenever they sell the shares. For example, I invested 1 crore into an Indian company under the FDI guidelines on a repatriation basis. Then after 2 years, 3 years, if I sell those shares and I get say 10 crores, I get 10 times of what I invested. So that 10 crores, subject to whatever tax he has to pay in India, can go outside India. There's no prohibition. This investment is called as repatriation basis, for which you have to make sure that you follow the FEMA regulations, where the sector in which you have invested should be allowed in terms of FDI guidelines. Whatever pricing guidelines you have to follow, you have to follow. Third, whatever reporting you have to do with RBI, you have to do. If you have followed all these 3 points, if you have invested on repatriation basis, whenever there is a capital appreciation, whenever you get the liquidity by selling the shares, you are allowed to take the money outside India. But on a non-repatriation basis also under FEMA, there is a route. And that route is typically available to non-resident Indians. So repatriation basis is de facto available to non-resident Indians and non-residents. So the difference between non-resident Indians and non-resident. Who is a non-resident? Non-resident is a guy who is not a resident of India. Neither is a non-resident Indian. Who is a non-resident Indian? In a simple way, if I am a person of Indian origin today, right? I am born in India, right? And I have gone outside India. And if I have that definition in terms of if I'm holding a overseas citizen of India card or whatever definition which Raman mentioned in the previous slide, if you're qualifying as an NRI, wherein you are connected to India, but you are currently not a resident, and you are qualifying the definition of what Raman mentioned, then you become an NRI. So being an NRI, I may have money in India in my saving account. I may want to invest in India and not follow the FEMA guidelines because it could be too onerous for me. I want to invest in a sector which is prohibited for FDI. I don't want to follow pricing guidelines. I don't want to report my investment to RBI. Then as an NRI, if you are qualifying in the definition of NRI, you also have a non-repatriation route, wherein you can say that, okay, I'm investing from abroad in foreign currency, or I'm investing from my Indian NRO account, which is basically your saving account when you were living in India and you went out, that became a that got redesignated to NRO account. You can invest from that account also and declare your investment on non-repatriation basis. If you are declaring your investment as a non-repatriation basis, then typically other than real estate, other than agriculture, there is no sector which is prohibited. You can invest. But if you come under repatriation route, there are other sectors which are prohibited, right? Defense, not allowed. Atomic energy, not allowed. Lottery, not allowed, right? Second, pricing guidance don't apply. If the fair valuation of a company is 100 crores on repatriation basis, you have to invest on or at that price. But if you're coming under non-repatriation basis, it is between you and the company. If the company wants to give you discount to the fair value, they can give. Third, there's no reporting which has to be done with RBI. It's as good as a domestic investment. The only difference here is on a repatriation basis, you can take the money out when there is a capital appreciation. But on a non-repatriation basis, you cannot take that money out. It will go back to the non-repatriation account. Basically, if you have invested through NRO account, the money which you get after selling your shares in the underlying company, that money will go back to the NRO account. And you cannot take that money back outside India under a normal route. NRO account may have permissible debits, permissible credits. Being an NRI, you will have a limit in terms of every financially how much money you can take. So money can go from those routes. But through share repatriation route, you cannot take that money. So that's the key difference between a repatriation and a non-repatriation investment. And non-repatriation investment is typically relevant for non-resident Indians who have some connection to India. Raman, next.
Yeah. Thank you, Prashant, for taking the repatriation and non-repatriation part. Let me take up the pricing guidelines, and then we'll have certain poll questions to just understand whether what is the understanding level of all the attendees which we have today. Okay. With respect to pricing guidelines, now let us start with listed company. For a listed company, the pricing must follow the guidelines as prescribed by SEBI. This ensures that the valuation reflects the market realities and is aligned with the regulatory standards. Now, we don't have much leeway here as SEBI's framework is stringent to maintain market transparency. Now, with respect to unlisted companies, the valuation is more flexible when you compare it with the listed company. It must be done on an arm's length basis using any international method for pricing. The key here is to ensure that the pricing aligns with the fair market value, just as if a company was a listed company. Additionally, this valuation must be certified by a chartered accountant, SEBI registered merchant banker, or a practicing cost accountant. Now, this certification adds as a layer of credibility to the valuation, making sure that it meets the regulatory and market expectations. For the companies who are undergoing the delisting process, there are additional considerations. They must adhere to the SEBI delisting of equity regulations 2009. These regulations ensure that the process remains fair and transparent, especially with respect to the shareholders' exit options and pricing during the delisting offer. Moving to swap of instruments, if an unlisted company is swapping equity for another form of instrument or equity, the valuation should be done either by a SEBI registered merchant banker or an investment banker outside India. Now here, the key is to understand that under swap of equity instruments, only SEBI registered merchant banker or investment banker registered outside India with those regulatory authorities are only allowed. With respect to subscription to MOA, that can be done at face value. However, they are subject to the entry rules and sectoral caps set by the government. Now, with respect to the share warrants, the pricing and the conversion formula should be determined upfront. This is a crucial step as it defines how the value of the warrant will be assessed and when it is exercised into equity shares. The upfront agreement ensures that there is no ambiguity regarding the future pricing of the underlying equity. With that, let us move to a concept of foreign investment in LLP, which is provided under the Schedule 6 of the NDI rules. Now, foreign investment in LLPs are who can invest in a LLP? Now, there is a clear-cut exclusion that investors from Pakistan and Bangladesh are not permitted. So both the individuals and the entities from other countries can invest, provided they are not from the restricted jurisdictions which are there. Now, the manner of investment can be in two ways, either through capital contribution to the LLP or by way of acquiring or transferring the profit sharing rights. This gives the flexibility for structuring the LLPs where investors may prefer a limited involvement. Now, an LLP receiving 100% FDI under the automatic route and which is not subject to any FDI linked performance conditions such as minimum capitalization or any lock-ins which are there. These kind of entities can be converted into a company or vice versa. Now, because of this condition, this allows flexibility in terms of structuring when the business later wants to raise equity or list on a stock exchange. Now, coming to the pricing requirement. When foreign capital enters or exits an LLP, it should be priced at a fair value, following an internationally accepted method similar to pricing norms under FDI in companies. This valuation needs to be certified by a chartered accountant, cost accountant, or a registered valuer, ensuring that the credibility and fairness is there in terms of the pricing. Now, this part is crucial. If you look at the transaction, how the pricing needs to be there with respect to transfer between person resident in India to person resident outside India, it says consideration should not be less than the fair price. When it comes to transaction between transfer from person resident outside India to person resident in India, the provision says consideration should not be more than the fair price. Now, when you look at the wordings which are there, they tried to ensure that there is no undervaluation during the inbound investment and there is no overvaluation while exiting. Both of these have been seen as controls on the capital flows that are happening. Now, let us take up some poll questions on the provisions that we have gone through till now and understand where are we in terms of the presentation that is going on. Now, let's say there is a startup A, an Indian entity with 100% Indian ownership. It receives 2 crores investment from Indian company B. Now, Indian company B is owned by Indian residents. Now, is it that this investment will fall under indirect FDI? I would request attendees to answer in the chat box. Quite a few have answered. Answer is no. Since company is Indian owned and controlled, the downstream investment is not considered as an indirect FDI. Let us move to our next question. Now, there is one company X, which is 49% owned by a US investor. However, the shareholders agreement gives the US investor some veto rights over the budget, strategies, CFO appointments, and all. This company X invests 1 crore in a Indian company Y. Now, is this investment downstream investment?
You want me to answer, Raman?
No, these are poll questions for the attendees.
Okay, got it.
So there are mixed responses in terms of yes or no. Let us look at what the answer is. Now, the answer is yes, this would be considered as a downstream investment. Even though the ownership is below 50%, there is control which is there. Now, when you look at the ownership versus control test, one of the condition is there is control in terms of investment or in terms of controlling the management. So this investment would be treated as indirect FDI. Next. There is an Indian company C, which is foreign owned and controlled. It invests 4 crores in an Indian company D. No Form DI, which is downstream investment, was filed, and there is no auditor certificate which was submitted. Now, what is the compliance position for this company? Let us wait for a few more seconds for the attendees to respond before we reveal the answer. Okay, majority of the team members have answered as option C, and the option C is correct. FEMA violation due to non-reporting. Now, Form DI and this auditor certificate are mandatory for downstream investments that qualify as indirect FDI. Next, Indian company H is a 50-50 JV between Indian promoter and a UK-based tech company. As per the agreement, this tech company approves all the IP, strategy, and key hires under the Indian promoter managed operations. Now, this company H invests in Indian SaaS-based startup I. Now, is this investment into company I considered as indirect FDI? Yes. So we have quite a few responses, and the answer is B. This tech company's control over the key business functions qualifies as control, and which would come under the downstream investment in indirect FDI provisions. Now, we have listed out certain practical scenarios which we wanted to discuss. I'll have Mr. Prashant take up these one by one.
Yeah, so as Raman was mentioning, there is a reporting requirement, right? Whenever there is a foreign direct investment into a company, if it's a direct investment, then you have to file Form FCGPR. If there is a transfer of shares between resident and non-resident, then you have to file FCTRS. If it's a downstream investment, then you have to file DI form. So typically, the way the firms portal was defined, designed previously, at one go, you could only file one form. So if I have to file, say, 4 FCGPRs, if I have 4 investments, right? If, for example, if I have foreign investment on day 1, then day 15, I have one more, day 30, I have one more, day 45, I have one more. Under FEMA regulations, the FCGPR has to be filed within a specified time, which is 60 days, right? So what used to happen is, once you file FCGPR, that goes to your authorized dealer. He has to review it, then he has to approve it. Right. So typically it used to take 2-3 weeks for basically getting approval for FCGPR. And if you had multiple foreign investment, then the system was not allowing to file multiple forms. You have to first file the first, then get it approved, then you have to file the second. And if you have multiple FCGPR which you have to file within a specified timeline, then the timeline used to get breached. But off late, from last 1 month, RBI has changed this system, wherein now you can file multiple forms, the portal allows. But previously, from last 6-7 years, it was only one form at a go. And for companies which have received multiple investments within a specified timeline, we're not able to manage this, because the process itself is, it goes to the AD. AD may have a lot of comments. They will reject it. Then you have to again file it. So that used to be a big pain for the companies. But after representation to the RBI, and now RBI is allowed, wherein you can file multiple forms. And that has happened recently, only 1-2 months back. Whether investment by non-resident in convertible note qualifies as FDI. What are the implications if the note is converted later? So if you see the FEMA regulations, any instrument which is compulsory convertible, when I say compulsory convertible, your compulsory convertible preference shares, your compulsory convertible debentures, your equity shares are coming under the ambit of foreign direct investment capital instrument. As long as you're able to qualify the definition of FDI, the conditions of FDI, then you can invest in the foreign company. But there is a parallel regulation, which is the ECB, external commercial borrowing. Anything which is not a capital instrument, which is not fully convertible, which is not equity, ECB gets triggered, right? So convertible note is a hybrid instrument. It could be at the option of the holder. The convertible instrument may get converted, or the convertible or the holder may have a right to call back the money. So it's a hybrid instrument. It's like optionally convertible instrument. So under FDI guidelines, if you are a startup, so there's a definition of a startup. If you are a startup which is recognized with the Department of Industry in the DPIIT, then you get the certification of startup if you qualify the definition of startup under the DPIIT regulations. And if you have that registration, then if you are getting any investment in a convertible note above 25 lakhs, so one of the conditions is it has to be above 25 lakhs, then you can have a hybrid instrument which will qualify under the definition of FDI. Otherwise, if you're not a startup, if you're getting money anything below 25 lakhs, then that will not come under FDI. It will go under ECB, and ECB is again a different regulation, and there are a lot of restrictions there. So convertible note is allowed if you're a startup and if you're getting more than 25 lakhs from an investor to qualify as an FDI. In case of rights issue of shares to a foreign holder, are pricing guidelines under FEMA applicable? What if it is at par or at a discount? Now, this is again a practical question. If you see the FDI guidelines, if you are doing a rights issue, then the price at which you are offering shares to the non-resident should be the same price at which you are offering to the resident. There is no fair value mechanism. If you are giving price, if you are pricing your shares at 10 rupees, you cannot give it at a 9 rupee to a foreign investor. It has to be at 10 rupees, and it need not be again a fair value. Your fair value could be 100, but you are giving it to all the shareholders at 10 rupees on a pro rata basis. Then the foreign investor will also get the shares at 10 rupees. But there's a catch here. A lot of people used to basically misuse this provision. If you see the pricing guidelines for a non-rights issue, which is basically a private placement, people used to, if a company wants to give it a discount to a foreign what do you call non-resident, because they were applicable pricing guidelines, they were not able to do it. So what people used to do is they used to give shares. First, they used to give rights issue to all the existing shareholders of a company, and one of the existing shareholder used to renounce his right to the foreign investor. Right. And that's how they used to say that this is a rights issue and the pricing guideline doesn't apply because the shares are coming out of a rights issue through a renunciation from the existing shareholder. But that's not allowed under FEMA. The moment there is a renunciation, then you have to follow the pricing guidelines which are applicable to you in terms of private placement. So that's the catch. People used to structure this by just creating a rights issue mechanism and getting the shares renounced. But RBI has levied huge penalties on that. So we should not take that route. Consequences: if the money is not refunded, neither the shares have been allotted within 60 days from the receipt of the funds. So under FEMA, within 60 days, you have to allot the shares. If you are not allotting the shares within 60 days, then you have 15 days to refund the money. But if you have neither, you have 15 days to refund the money under company law and 180 days under FEMA. But if you have neither refunded the money, neither allotted the shares, then you neither can allot the shares, neither you can refund the money. You have to go to RBI, take approval. What do you want to do? Whether you want to allot, you have to take their approval. You want to refund, you have to take their approval. So this has to happen within a specified time. And if not, then without RBI approval, you can neither refund the money, neither you can allot the shares. When does the investing company allowed to record the transfer of shares in its books? So if you see the FEMA regulations, when this is more relevant from a transfer perspective, there is a transfer between a resident and a non-resident. As Raman mentioned, you have to file form FCTRS. Now, the onus of filing the form FCTRS is always with resident, whether the resident is a buyer or a seller. As long as the resident is involved in a transaction, form FCTRS has to be filed. And FCTRS has to be filed, and FCTRS has to be approved by RBI. Then only you should record the shares in the books of the company. As long as the FCTRS is filed and approved, you can record the name of the shareholder as a new shareholder, and you cannot basically record the name of the new shareholder until the FCTRS is approved by RBI. If you do that, then it's a violation of FEMA. For an initial transfer or allotment of share taken on record letter yet to be received, any subsequent transaction can be done for the underlying share. Again, this is a practical challenge. Assume that you are a non-resident who invested in the company. You were supposed to file form FCGPR. Take a scenario where FCGPR form was not filed. After 5 years, you want to sell your shares. When you are selling your shares, a resident buyer is buying your share. When a resident is buying your share, he will send the money outside India because you are a foreign shareholder. At the time of remitting the money outside India to you by the underlying bank, they will ask you for the RBI reporting, which you would have done at the time of investment. If you have not done that, then the subsequent transaction cannot be allowed by the RBI, by the authorized dealer. So they will first ask you to regularize your FCGPR filing. Then only you can do the transaction, but remittance cannot go outside India. Whether the payment of LFS regularize the offense under FEMA. So under FEMA, there are two eras. One era, which is basically prior to one era where the reporting was basically, the reporting is not beyond 3 years. So for example, in 2022, you were supposed to file something, right? Form SCGPR, form FCTRS, form DI, form ESOP. If you have not filed that form, then after you have time till say 2025 August, 3 years. If you are filing it now within the period of 3 years, there is a process of paying the penalty and then getting it regularized. But if your filing goes beyond 3 years, right? You were supposed to file something in 2020. You have not filed till date. Now you want to file it. Then you can file it, but there is no mechanism LSF. You have to go for compounding. You have to file a specific compounding application with RBI, wherein they will compound the offense. The penalties under LSF and compounding are completely different. Any offense which is within 3 years of period which is applied where LSF applies, you can pay the LSF and you can regularize the offense. Any offense which is beyond 3 years, then you have to go for compounding. What kind of right constitute control for FDI? I think we have already discussed. One is your percentage of shareholding in the company. Second is your board of control. If you are having control on the board, then that will amount to control. Third is special rights. So this I think we have already discussed. Do Taiwan and Hong Kong form part of China for the purpose of FDI regulations? Now, as Raman mentioned, if you are a border country means all these 5-6 countries. Your China, Pakistan, your Bangladesh, Nepal, Bhutan, right? All maybe 1-2 more countries. So if you have any countries who are our border countries, then any FDI from those countries will require prior approval of Government of India before the money comes into India. That's the restriction. There were a lot of questions which initially flowed, wherein because China shares land borders with India, whether Taiwan and Hong Kong would be treated as part of China, and whether any investment which is flowing from Taiwan and Hong Kong would also require Government of India approval. So the answer to this is Hong Kong will definitely be treated as part of China. Taiwan is currently not treated. Any investment from Taiwan would be treated as at par with any other country, not with the border countries. Hong Kong, again, it will be treated at par with the border countries.
Yeah. Thank you, Prashant, for the clarifications on the practical scenarios which are there. Now we'll quickly move to the discussion on what are the various filings under FEMA and how the portal appears and what are the details that needs to be filled in case of each kind of form. Now, we have two kinds of form filings. One is online, which is on the firm's portal or the FLAIR portal, which is there from the RBI. And one is offline, which is through the AD Bank. Under the online forms, we have something called SMF, which is single master form, and FLA, which is foreign liabilities and assets reporting. Under the offline category, which is to be submitted through AD Bank, you have Form FC, which is financial commitment for the ODI, ECBs forms, and the APR forms which are there with respect to the annual reporting of the ODI. Now, let us look at the filings and the steps which are involved with respect to the filings on the SMF portal. Now, the landing page of RBI firms portal looks something like this, wherein you have option for two registrations, which is new business user and new entity user. You might be able to look at these two options under the login button. At the same time, I'm moving my cursor toward the lower part of the screen, wherein you'll be able to see there are links given for user manual for entity master, user manual for firm's application, and then you have FAQs. These are the core documents which will help you with the filing process, which is there on these portals. Now, the total filing is a 3-step procedure, wherein you first go with the entity user creation. Then once the entity user is created, you move on to the updation of entity master. And once these two things are completed, you move on for the creation of business user. Now, this entity user registration, the process flows to RBI for approval. But in case of business user, this process flows to the AD Bank, whose IFSC you will be selecting during the time of registration. Point to note is that there is no email acknowledgement that is received post you create the submit the application for the entity user or a business user. Once the approval is received, only that email acknowledgement you will be receiving with the login credentials. entity user. Generally, the details which are required with respect to the entity user creation are with respect to the person who is authorized. You'll be required to mention the first name, last name of the person who is authorized, username which you want with respect to the entity user that you are creating it, mail ID where the login credentials needs to be received, then PAN of the authorized person, the mobile number and the entity name, entity type, either company, LLP or a startup, SIN number, the registered address of the entity. Regional office is based on the RBI regional office what you will be selecting, and you'll see that there is one attachment which is required called authority letter. This authority letter is provided in the user manual which is there on the website. The format looks something like this, wherein the authorization is being provided in case of a company. It will be to the respective person who is registering on the entity for the entity user creation or the business user creation, wherein this authorization is being uploaded for the RBI approval. You have standard details like name, PAN, whatever earlier details we have filled up with respect to the creation of login. More or less similar details would be required here, and the authorization needs to be provided by another director or officer who is in charge. Now, once the entity user is created, the next step is updation of the entity master, wherein you have a total of 4 tabs that needs to be filled up. First being the entity details, second being particulars of the investment, third the foreign investment which is there in the company, and the foreign investment information which is there. Now, this entity master needs to be updated by all the entities who would have received FDI prior to the creation of the firm's portal or after the creation of firm's portal. Now, when you look at the details which are available, the SIN number which needs to be mentioned, the name of the company, date of incorporation, PAN, and any registration number if allotted by RBI. Now, then you have a questionnaire with respect to whether the company is under investigation by Directorate of Enforcement or CBI, then that needs to be provided. Under particulars, the address of the entity, PIN code, the state information, mobile number, and the company email, which is to be provided. Then you have business activity details that needs to be mentioned. This is important because based on the NIC code that you select, all the approvals and later filing is linked to this NIC code that you'll be selecting. Then you have something called greenfield or brownfield. Greenfield is something where the entity is a new entity and which is receiving the funds, and brownfield is something which is an existing entity and the work is going on where the investment is coming in. Next, you have to mention the details of what are the foreign investment which is there in the entity as on the date of filling this entity master, which is the paid up capital of the company. And then the details of the foreign investment which is there, either in terms of portfolio investment, direct foreign investment, or direct investment which is there, that needs to be mentioned. Now, in the last tab, details such as date of issue or transfer, the type of instrument, whether it is a capital contribution or profit on sale of an LLP, profit share for an LLP, or equity shares needs to be mentioned in case of a company. What is the count of that instrument? Whether it is equity shares, then it's a number of equity shares. Then whether this reporting has been reported to the AD Bank or RBI. Here, let's say if the reporting is to be done for the first time, then you'll be selecting no and you'll be going ahead, because in case of the earlier process wherein ABIS portal used to be there for the filing of FCGPR, there was initial first time migration that had to be done to the entity master, and that's how the entity master had to update it here. Then whether any acknowledgement has been received from AD Bank or RBI, and you'll be clicking the checkbox with respect to the details that is mentioned are correct. and you'll go ahead and submit. Based on this information that you're submitting in the entity master, the later filings which you will be making in terms of business user, some of the details will get pre-filled based on what you enter here. Now, if I have entered already that there is a reporting which is due and it has not been reported, then that will get picked up when I'm submitting the FCGPR forms in the business user portal. Now, for business user, the slide is something similar, wherein you're trying to provide the details of the authorized person who is authorized to register as a business user for the company. Username is something which needs to be different from what username you would have given for the purpose of entity user creation. If there is a similar user which is appearing as existing in the system when you are entering the username, then you will have to go for another username. Note that this business user process flows to the AD bank. That's the reason if you see there is a option for selecting the IFSC code with which or from where the reporting needs to be done. Then you have two questionnaires with respect to whether this business user is for a INFI form or whether this business user is a LLP form. This INFI is nothing but institutional foreign investors. If that kind of form is being filed, then you will have to select yes. Similarly, similar to what you have for an entity user authority letter, you have authority letter for business user creation as well. The format is provided in the user manual for firms, and these formats keep on changing on a regular basis by RBI. So whenever you're creating a business user or an entity user, ensure that you're referring to the updated user manual before you're going ahead with the process to avoid any rejections at a later stage. Here, the only point to note is if one of the director is being authorized for creating the business user, the other director has to provide the authorization with respect to the creation of the business user. The format or the content would be more or less similar with respect to the entity user creation. At few places, you'll have mentioning of business user instead of entity user in the content. Once business user is created, the dashboard appears something like this, wherein you have the details of FCGPR or FCTRS or the other forms which are available in the SMF portal appearing on the dashboard. Let us understand how few of the forms which I have selected for the purpose of understanding for filling of the form. And let us go tab wise as to what details are to be mentioned while filing the same. Now, FCGPR is something wherein which is required to file when there is a foreign direct investment which is coming in an entity. It can be initial investment, subscription to MOA, or a further issue of capital that can happen through a private placement or another form. Now, issue details, you'll have to mention the date of the issue, nature of the issue, which I have mentioned about, and any initial FCGPR number if it is a subsequent filing of a earlier form. Now, then there is a question which is below this information asking you whether this current reporting has taken into account the pre-transaction shareholding pattern or not. Now, earlier in the entity master, if you have submitted the details of the foreign investment which is there as on that day, even though reported or not reported, then based on that, the answer to this question would be yes or no. Based on the answer that you select, the details would appear under the shareholding pattern tab, which is there, which will act as a checkpoint for you to understand whether the flow is happening properly or not. Now, the second tab is talking about foreign investor details, wherein you have sub 4 tabs asking you for the general details, particulars of the issue, mode of payment, and investment details. Let us look at one by one. General details of the investor like name, address, are be filled up here. And what is the nature of the investing entity, either individual or a corporation or a body corporate, which is there, which needs to be selected. Then the next tab, which is particulars of issue or allotment to each investor, the type of equity instrument that we are talking about, number of instruments that are being issued, the conversion ratio, if any, in case of convertible securities that are being issued, the number of equity shares on a fully diluted basis in case the conversion is being issued. If equity shares are being issued, then the conversion can be 1:1. That can be mentioned here. Then you have the face value, premium, if any, and the total issue price per instrument, which is face value plus premium. Based on the number of instruments that you enter, the gray fields will get enabled or auto-calculated in terms of the total amount of consideration. Once the details are filled up, you can click on add issue and the details would get captured in the below table. Next, mode of payment. Whether the remitter is from different from the foreign investor. If that is there, you have to click on yes and provide the details of the remitter and the investor. Name of the AD bank through which the remittance is received, address of the AD bank needs to be provided. Based on this information that we fill up in the earlier tabs, the total inflow and the amount for which the equity instruments have been issued, both will get updated. Next. Third tab is basically the details which you fill up in the previous tabs will get auto-populated in the third tab. So I've skipped that tab. I have come to the particulars of issue tab, wherein details of the equity instrument which is issued, number of instruments, the conversion ratio, whatever we have filled up earlier, all will get auto-populated here. At the same time, there is option provided for you to mention the fair value of the shares. Then you have an option to select upload the valuation certificate to justify the fair value. The shareholding pattern. So in the first tab, wherein if you select based on the selection that you make, whether it is a transaction is already reported or taken into consideration in the pre-transaction level or not, based on the selection of the option that you have there, the numbers would get updated here. If you have selected yes, then the numbers of pre and post will appear same. If you have selected no, the numbers would change because that has not been taken into consideration is what we are trying to tell to RBI with respect to the shares that are being issued. Then you have a tab which is common for all the forms that we are going to see, which is mail notifications. Earlier, before this new update was provided in the RBI portal, but what used to happen is if I have filed a form, if there is any remarks that have been given by RBI or AD Bank against that form, the form used to get rejected. There was no resubmission concept, how you have in MCA. Now they have introduced that concept wherein if there are any rejection remarks or resubmission remarks that they have provided, those will appear under the mail notifications tab. From there, you will be able to resubmit the form again with the correct attachments or correcting the details that are provided in the resubmission remarks. Now, moving to the FCTRS form, you have the details that needs to be selected. So majority of the details are understandable based on the language that is there. And so let us go through one by one. Common details, you will have to select whether transfer is by way of sale or gift, whether FCTRS reporting is new or subsequent. If it is connected to an earlier FCGPR number, then that FCGPR number reference number needs to be provided. Now, whether this transfer is from a resident to non-resident or non-resident to resident, that needs to be selected. And based on that, the transfer type and reasons for the transfer needs to be selected and provided over there. Next, once you select who is transferring to whom, you'll have to mention the address for both of them. Now, under FEMA, the reporting obligation is always on the resident individual. For example, if a resident is transferring the shares, if the transfer is between resident to non-resident or non-resident to resident. In both the scenarios, the resident is under the obligation to report this. So that is the reason you have both the options appearing over there, and the filing is to happen accordingly. Particulars of issue. What is the type of equity instrument, number of instruments, conversion ratio, if any, number of shares, face value, and transfer. These all details one filled up and added, they get populated in the table below. Again, if you look at the tabs, again, shareholding pattern, mail notification, which is common, similar to what you had earlier. So those tabs are being skipped because those are common in majority of the forms that you have. Then you have form DI, which is for the indirect FDI, which is there. If yes, then you will have to provide the FCTS number for the earlier initial FDI. And investor type details such as investor type, name, address, and other details needs to be provided. Date on which the investment became a direct investment, allotment, and remittance, if any, and the conversion ratio, if any. Again, you have a similar question whether this current reporting has been taken into account in the pre-transaction shareholding or not. So if you recall, in the entity master, there was option to mention indirect FDI also. If that is entered over there, then accordingly your answer here would vary. If that is not entered, then you'll have to report. Again, you have similar details of the investor type and when this has got converted. Select the attachments and go ahead with the filing. Then you have ESOP form, wherein the share ESOPs which have been issued by the Indian company to foreign investors or foreign people needs to be reported. Reporting is generally to be done by the Indian company. Scheme under which these ESOPs are issued, then the relevant extracts of the scheme, date of issue, and what are the number of ESOPs that have been issued, and the price per instrument needs to be reported. It's fairly simple form. Next, we have LLP form 1, which is for the FDI that is coming in. So based on what you enter in the entity master, few of the details are pre-filled, like the SIN number, PAN number, the entity name, and the application date, which would be the current date when you're reporting it. Then you have the entry route, whether it is automatic or a government route. Then you have sectoral caps. These were also common in the earlier forms which we saw. Just to avoid repetition, this part was not there earlier. Then you have the below part, which is the tabs, which we saw in the earlier slides. Then you have the common details tab and the shareholding pattern tab. Common details are with respect to who is the investor, remittance details that needs to be filled up. Then you have details to be mentioned, such as whether remittance is through a banking channel or is it through a debit to a NRE account or FCNR account. Then whether the changes in the shareholding has been reported or not. Similar kind of questions you will be having here as well. And then you have the details that need to be mentioned with respect to remittance and the attachments which are there and submission. Now, with this, we have completed the part with respect to FDI. We can break here to see if there are any questions till the FDI part before we move to the ODI.
Okay, sir. So the first question is, can a partnership get FDI or foreign investment? And if so, what are the complaints need to be complied? So this is a question raised by Kirubakaran.
Okay. Prashant is also there, right?
Yes, sir.
I'm there. You want me to answer?
Yeah.
As a partnership firm on a non-repatriation basis from an NRI, they are basically allowed to get FDI. But partnership firm on a repatriation basis, either from a non-resident or a NRI, they are not allowed to get any kind of an FDI into the company.
At the same time, we need to look at the definitions which are provided in the India rules with respect to the entities as well as the definitions provided for the equity instruments. To look at this.
Yeah. Okay. So the second question is, what about a producer company making films in India, borrowing money from person outside India? So question raised by Mr. Nitin.
Again, see, borrowing is always what do you call factor of not coming under FDI. It is called as external commercial borrowing. So for ECB, I think you have different guidelines that doesn't fall under the FDI regulations. So if I've understood your question correctly, you are saying that you basically are or maybe the question says that if there is a company which is into film production, whether they can receive ECB. Now, maybe I'll just spend 2 minutes so that you get clarity on that. That's not the topic of discussion today, but still maybe I'll answer this for you. Now, ECB for a production company would mean ECB for a company which is basically creating an IP, right? Film is nothing but an IP, and it could be categorized as a production of a IP. For that, if it would have been a FDI sector, it's 100% allowed. Because FDI is 100% allowed, under ECB regulations also, you are qualified to get ECB. But under the ECB regulations, there are 4 important aspects which have to be taken care when you're getting any kind of an ECB. One, from whom you can get the ECB. Second, what is the interest which you can pay to a foreign lender, right? Third is basically what could be the maturity under the ECB regulations. It's not that you can just take money and then give back as and when you want. There are certain conditions, right? Fourth is the all-in cost ceiling. All-in cost ceiling includes your interest and any other cost which you can pay. So I'm not getting into the specifics of that because it's not an FDI. It will fall under ECB. All these 4 conditions have to be seen. If you are able to comply with the 4 conditions which I mentioned, then you can get the ECB under the sector which you just mentioned.
Okay. Thank you, sir, for the detail. So
the next question is
what if any person
Hassan, go ahead.
What if any person who is Indian invests in a foreign company but does not control to the extent of 52%, then is it indirect FDI? Question raised by Mr. Nitin.
Can you repeat the question?
Yeah, it was not clear.
What if any person who is Indian invests in a foreign company but does not control to the extent of 52%, then is it indirect FDI?
No, sir. See, FDI is always an investment into an Indian company, not into a foreign company. So the concept of FEMA under indirect foreign investment regulations will apply to investment into an Indian company by a non-resident entity or a person resident outside India. So your question is predominantly an individual investing abroad. So that doesn't get triggered by the indirect foreign investment regulations. This will come under ODI. So ODI regulations have to be followed, and whatever is the host country law for getting investment from their host country law perspective, that has to be seen.
Yeah, just to add to that, the question talks about ODI and not FDI. With respect to indirect FDI, ideally the funds needs to flow in India and then flowing to another entity. Coming to ODI, whether funds are moving from India to outside and then again coming back to India, that is something we need to look at the round tripping provisions which are there in the ODI, which will be taking up at a later part in this session.
Okay, sir. So
let us take one more question before we move to ODI, considering paucity of time.
Okay. So whether NRI invests from his NRI account, can it fall under FDI?
Yeah, it will fall under FDI. Yeah. So basically, if you see the FDI regulations, any money which is either coming from abroad or from an NRI account. So NRI account is nothing but a foreign currency account. So if it's an investment from a NRI account from a NRI, that will come under FDI regulations, and he has a choice whether he want to call it as a repatriation investment or a non-repatriation investment. So that's possible.
Yeah,
and
just
they
to
are
add
specifically asking. whether their FCGPR is applicable.
Yes, FCGPR is applicable. FCGPR has to be
Once-
filed. It is nothing but FDI investment, and whatever is applicable in terms of your pricing guidelines, in terms of reporting to RBI, everything has to be followed.
So just to add there are two types of accounts which are there for the individuals, which is NRE account, non-resident exchange account, and then you have NRO account. Each account has permissible debits and credits, which can come in. What are the debits that are allowed and what are the debits credits that are allowed? Based on that, these provisions of FDI will get applicable.
Okay.
Right. Then we'll move to the next part of the session, which is overseas investment under FEMA. Let us begin by understanding why Indian businesses are going global and what is driving these overseas investments today. Now, first, you have the strategic intent behind these companies which want to have global reach to acquire customers, talent, tech, or resources. That's where the ODIs are coming in. Second, it's about acquiring control or collaboration opportunities which are there abroad, like whether through a wholly owned subsidiary or a joint venture, or even acquiring a foreign brand. Third, HNIs or corporates, they want to diversify their portfolio in terms of and they want to go beyond the Indian markets in the light of currency risk or the global trends that are there. Lastly, you have the growing participation in the startups and tech hubs abroad, especially in US, Singapore, or the UAE. Now, let us try to understand these three key acronyms which are there. You'll be hearing these acronyms for the next few slides to come. First being ODI, which is Overseas Direct Investment. Basically, it means you have control or a significant influence in the investment that you have made. Second, you have OPI, which is Overseas Portfolio Investment. It's like a passive holding and there is no control attached to that holding. Third, you have a unique identification number, which is issued by RBI per foreign entity for the investments that you make. Now, in the earlier slides, I mentioned that there are certain forms which can be filed online, and there are certain forms which needs to be filed through AD Bank. This is something which comes through the AD Bank. Against the filing, UIN number is allotted, which is per entity basis. Now, similar question as to FDI, where do I start? What do I read? You can initially start with the FEMA overseas investment rules, which is basically dealing with the ODI, OPI, or the IP, along with the general principles of the new overseas investment regime. Earlier, we had FEMA 120 regulations. Now, these are taken over by the Overseas Investment Rules 2022. Then you have RBI issued Overseas Investment Regulations 2022, which will deal with debt and non-fund-based commitments, mode of the payment, reporting requirements. Then you have Overseas Investment Directions 2022. These are directions to AD banks. This will provide clarifications on the rules as well as the regulations. Then you have something called LRS scheme. You would have heard about it, issued by RBI Master Direction, which will talk about provisions of LRS relevant where the resident individual is making overseas investment. Then you have Master Direction on Overseas Investment, which will have all the compiled directions with all the amendments. Then you have Master Direction on Reporting, which will have the reporting requirements of all the frameworks under FEMA, including ODI. Next, you have certain key definitions to understand the overseas investment rules. First being control. Control means the right to appoint majority of the directors or to control management or policy decisions exercisable by a person or persons acting individually or in concert, directly or indirectly, including by virtue of their shareholding or management rights, or through certain shareholder agreements, voting agreements that entitle them to 10% of more of the voting rights or any in any other manner. Now there are conditions provided. Let's say control can come through if you have the right to appoint majority of directors, or if you have the right to control management or take policy decisions, either acting individually or in concert along with other people, other investors, directly, indirectly, based on their shareholding pattern or based on the agreements which are there for the shareholding which is there. This coupled with the 10% or more of the voting rights in the entity. Then you have something called financial commitment, which means the aggregate amount of the investment made by a person resident in India by way of overseas direct investment, debt other than overseas portfolio investment in a foreign entity or the entities in which the ODI is made, and shall include the non-fund based facilities extendable by such person. Now, this financial commitment is an important term because this will determine as to how much of investment can be made in an entity by a Indian entity or by a resident individual in terms of OI. We'll look at how this is calculated in the later slides to come. Then you have definition for last audited balance sheet, which means the audited balance sheet as on the date not exceeding 18 months from the date of transaction. There are conditions attached to the net worth wherein this last audited balance sheet will come into picture. Then you have something called strategic sector, which will include energy and natural resources such as oil, gas, coal, mineral oils, submarine and startups as deemed necessary by central government. They'll be defining them as strategic sectors. This will also come into handy when we are discussing the next slides to come. Now, what are the different kinds of overseas investment? We discussed three terms earlier: ODI, OPI, and UIN. Now, here in this slide, we are trying to talk about what is ODI and what is OPI, and what are the other investment patterns that can come in. Let's start with ODI. This is where Indian entity has control or significant influence in the foreign entity. Think of it like you're setting up a subsidiary or a joint venture abroad. You're not just investing it, but you're running the show with either board control or decision rights or operational say. Now, this route involves you to file the reporting through Form FC, and then the APR filing, which is there on a yearly basis. We'll discuss those in detail in the other slides to come. Then you have the other type of investment, which is overseas portfolio investment, which is opposite of ODI. Here you're simply buying the foreign securities, like let's say Apple shares are there, or you have Meta shares which are there, or you are investing in ETFs or US mutual funds. This might be for some passive returns wherein you don't have any say in management or any strategy. These conditions are simple. There is no control or influence. These investments are allowed under LRS scheme, or if there are any specific RBI routes, under those it will be allowed. Examples which I have mentioned earlier. Then you have certain other routes, such as which do not fall under ODI and OPI, but you have gift or inheritance of foreign shares from a relative. Again, relative definition is something which comes from the Companies Act. Then you have ESOPs or from the foreign employer, which is issued to a resident individual. These are also allowed under FEMA, but are not categorized under direct or portfolio investment unless they are followed by active decision making. Basically, the all classification depends on whether control is there or not. Moving to the next slide. Overseas investment by Indian entities. Now, who all can do this overseas investment? I'm using the terminology carefully. I'm referring to overseas investment, which will include both ODI and OPI. Applicability, or basically who can invest, is Indian companies, LLPs, partnership firms, or any other eligible entities, which we'll be talking under the other slides to come. permitted investments for the entities which we have discussed earlier. It can be equity capital of a foreign entity. It can be a JV or a wholly owned subsidiary. Then you have debt instruments subject to the financial commitment limits, which we'll be discussing, or in terms of guarantees with respect to corporate performance or bank backed guarantees limits. This is what I was referring to in terms of financial commitment. Up to 400% of the net worth is allowed with respect to the ODI. Up to 50% of net worth is allowed with respect to OPI. Based on what category it is falling in, the level of investment or the amount quantum of investment will depend upon the net worth. For net worth, we will be looking at the last audited financials, which are not older than 18 months. Certain conditions, like the foreign entity must be engaged in a bona fide business activity. It is not in the strategic sector, which we discussed earlier, unless it is specifically allowed. No investment is allowed if the entities are engaged in real estate, gambling, or financial services without any specific approvals. Now, similar to how we have in FDI, there are certain sectors where the investments are prohibited. Then compliance requirements, we have the UIN number, which needs to be obtained from the RBI for the investment. Annual performance reports, which needs to be filed. And then you have reporting in terms of disinvestment or restructuring that is happening. We'll be discussing about the reporting and annual performance obligations in the next slides to come. Then we'll talk about what is overseas investment by resident individuals. Route, as I mentioned earlier, will be through LR scheme, which is up to 250,000 USD per financial year. Permanent investments include equity capital in foreign entity through ODI or debt instruments if not resulting in control. Mutual funds, ETFs, listed shares which fall under the OPI category without control or no control. Individual cannot acquire control or act as a proxy for an entity. If the control is there, then there is restriction in terms of the step down subsidiaries as it may lead to a layered investment. We have something called round tripping which will come in, which we'll be discussing in the next slides to come. Then investment in strategic sector, which is restricted as discussed earlier. With RBI approval, this can be done. Then key points with respect to an individual if they are going for investment, try to use only one or designated ED bank so that there is consistency in terms of reporting. And there is documentation with respect to all the investments that are made. Second, keep the source documents and all the valuation reports handy for future reference. Then these UINs must be obtained for each ODI entity. Then what are the obligations for a person resident in India? Proof of investment. Submit the share certificates or the other documents as evidence of ODI. This needs to be done within 6 months from the date of remittance or capitalization of dues. UIN requirement. You need to mention the UIN number either before the first remittance or acquisition of the equity capital. We'll be looking at how to obtain UIN through filing of Form FC in the next slides to come. Routing of the transaction needs to be routed through particular UIN only. It must be routed through the same designated ED bank. If there are multiple residents who are investing in the same foreign entity, all those transactions needs to be routed through one common ED bank. Repatriation obligations, dues, whatever are there from the foreign entity must be repatriated to India within 90 days. 90 days of the due date when it is due, or the actual transfer when it is happening, or liquidation of the investment that is there. This disinvestment generally comes with certain conditions such as an ODI which is made needs to be there for minimum 1 year holding, and there should be a proper valuation for the disinvestment that will happen. I'll call upon Mr. Prashant to take up the overseas investment ID registered trust society as well as the round tripping provisions which are there.
Sure. Thank you, Raman. So I think on the ODI, the plain vanilla route which Raman explained in terms of who can make ODI investment, what are the conditions of ODI, are basically a flip of FDI. So as Raman mentioned, when there's investment into India, and as I mentioned in my previous topic, it's more of a FDI. But if there is investment happening outside India, it's an ODI. Now in ODI also, I think there are few nuances which everybody should understand. One is the nuances in terms of round tripping, which maybe in my next slide I will take it up. This is more easier slide wherein if a Indian entity or an Indian individual wants to invest abroad, which is basically investment into a registered trust or society as a topic which I am discussing now, then there are 2-3 important conditions which you should be aware. One, if you want to invest in sectors which are into education sector, healthcare sector, then only the investment from India into a foreign jurisdiction in terms of ODI regulations is allowed. It cannot be, it is not allowed in any other sector. It has to be an education company or it has to be sector which is into healthcare, which is basically your hospitals or any other healthcare. So if it's a registered society or a registered trust, then you can only make investment into trust and society which are into education or healthcare. So when I say investment, and when I say investment into a registered trust or a society, we also need to understand what is the investment into any other entity. So any other entity could be your entity which is into the business of any other commercial business which is which is basically a business which is commercial, right? So it could be a corporate company, it could be a private company or any other company which is of that jurisdiction, then it's a pure play ODI which Raman discussed. But if it is not a company and if it's only a trust and a registered trust or a society, then these are the conditions which are applicable. One, it has to be a registered trust or a society which is engaged in the education business or a healthcare sector. Second, the trust wherein you are investing should be a registered trust, right? And then you also need to make sure that the entity where you are investing has a 3-year track record. So this is the basics of registered trust or society. I'm not getting in too much into the process of it because I think that's not more relevant. The relevant for maybe the crowd who has attended this session would be more commercial in nature, which I think Raman has already explained. So maybe Raman, you can go to the next slide where I will take it up, the round tripping bit of it. So round tripping, maybe I'll spend 5 minutes to give you a insight into what exactly is round tripping. Round tripping is nothing but money going outside India and then the same money coming back into the India. So previously, before 2022, when the erstwhile ODI regulations were in effect, that time RBI was clear that any money which goes outside India should not come back to India. So they used to take this as a money laundering, wherein they were not clear in terms of how the source of the money is getting generated and how the money is coming back to India. So typically, if somebody is using that kind of mechanism, it was more colored as money laundering. Hence, RBI was not allowing any kind of structures wherein there is one structure which is there outside India, and that structure again has a structure into India. So for example, if I have a company in Singapore, right, and which is my wholly owned subsidiary, and then that Singapore company again has a subsidiary into India. So holdco is in India, step down is in India, but in my example, the subsidiary is outside India. So these kind of structures RBI didn't allow because you have one entity abroad which is your subsidiary, and that subsidiary again has an entity into India. So before 2022, before the new regime of ODI regulation, these structures are not allowed. But in 2022, when the new regulations came into effect, RBI basically allowed these kind of structures with certain conditions. One condition was the structure, the structure which I just spoke, wherein we have one entity abroad and again there is an entity into India. There should not be more than 2 levels. So you can have Singapore, you can have India. One level is Singapore, second level is India. But you cannot have Singapore, China, and then back to India. So in this example, you have 3 levels, right? So RBI said if you're having 2 levels, then it's fine. We are allowing you the structures which could be a round tripping structure, but that will not be prohibited. So one is the structure should be a 2-level structure. Second, the second exemption is the structure which is basically a controlled subsidiary will only be counted for counting one structure. If you have any company wherein you don't have more than 50%, you have only 45%. So that structure is not counted. So for counting two structure, it has to be a controlled subsidiary that will be taken as one structure. And then if that controlled subsidiary has a subsidiary into India, then it's absolutely fine. And this kind of round tripping restrictions are not applicable to NBFCs, bank, insurance companies, government companies, because they have different requirements and they can have different structures. So round tripping as a concept is basically to prohibit any kind of money laundering. Before 2022, it was not allowed, and now it is allowed, but you have to make sure that you cannot go beyond two structures. That's it, Raman, from my side on the round tripping.
Got it. Let us look at certain practical scenarios. What happens in an ODI where there is no remittance or the remittance is delayed? Now, just to give a background, earlier, let's say there are many jurisdictions where shares are allotted before capital is actually remitted. Or let's say there are promoters who are often subscribers to MOA, and bank account takes time in certain countries. Now, in this case, what happens is this will result under ODI on a deferred payment basis, and was treated as a non-compliance under the FEMA 120 regime, which Prashant was talking about. Later, once the new regime has come in August 22, there are certain reliefs which have been provided, wherein this remittance is allowed after share allotment if the timeline is clearly defined in MOA or the agreement which is there or the local law of that country. If, let's say, those no such definition is provided, then remittance must be done before or at the time of setting up or acquisition. Period needs to be decided upfront. Whatever document that you are referring to, the estimated time needs to be decided upon for the operational readiness. Accordingly, the document can be drafted. All this documentation ensure that these are points that are documented and the reporting is communication is made to the banker on this front. Now, let us look at certain list of documents generally which are required for a ODI transaction. Now, we'll start with board solution, wherein the authorization is provided for the investment. The AD bank generally won't even process your request if this document is not provided to them. Second is Form FC, which is a form similar to how we have FCGPR or CTRS, different forms which are there. There's this Form FC for financial commitment, which has totally 5 sections in terms of the ODI that ODI or OPI transaction, overseas investment that is being taken up. Then you will need the certified copies of MOA, AOA of the foreign entity and translated to English if required. Then will be the host country if there are any specific regulatory approvals required, like for example China or Middle East countries. Then those needs to be obtained first and then submitted to them. Then you have a valuation report coming in, which needs to be from a CA or a merchant banker. Next, you have a declaration or undertaking which is required to confirm the source of funds and FEMA compliance, which is there. Then you have share subscription agreement or any other similar document, which will talk about the investment terms, milestones, pricing, and other key parameters with respect to the investment. Also, you can include a structured chart showing that the Indian investor on JV or the wholly owned subsidiary and any step down subsidiaries which are there. And then lastly, you have a net worth certificate of the Indian entity certified by CA. This will determine the financial commitment ceiling as well as the net worth criteria, which is there in the provisions for the investment part. Let us look at the pricing guidelines. So RBI has delegated the responsibility of verifying whether the valuation reports with respect to the valuation reports of the overseas investment. Now, these AD banks act as gatekeepers for all the pricing compliance. Each AD bank is expected to form a board-approved policy on the pricing guidelines, the acceptable documentation, as well as situations where the valuation may not be required. Now, practical issues when you deal with AD bank. Now, since these policies are being prepared by the banks with respect to the pricing as well as the documentation for ODI, these are not made publicly available. Now, this becomes difficult because each AD bank interprets differently the guidance which is provided by RBI. At the same time, they have a different set of documents with respect to the similar transaction which you might be taking up. Then a major point, what happens is while dealing with the AD banks, there are certain scenarios where there are certain hurdles raised by the bank after all the documentation is provided and submitted in full. So there is a lot of back and forth that happens with respect to the documents that are there. Then you have certain rigid requirements coming in from certain banks, such as they'll accept valuation report only from foreign CPA, or they'll accept the valuation only from an Indian CA, or something like that of sort. So it is advisable that with respect to any transaction, the discussion happens with the AD bank and you are in line with whatever the AD bank is looking at, so that there is not much of back and forth happening with respect to the same documentation and the transaction flows smoothly. Now, let us look at the event-based reporting, which is most crucial and overlooked aspects of ODI compliance. There are three major events that we are looking at. One is financial commitment, second is disinvestment, and third is restructuring. Financial commitment, ideally, it gets triggered at the time of remittance or the financial commitment is made. Disinvestment within 30 days of the proceeds. Restructuring, similar to disinvestment, within 30 days. Now, let me take up the financial commitment part, because this is where generally practical challenge comes in with the AD banks. So when you look at the financial commitment, the due date is the remittance or the financial commitment, whichever is earlier. Now here, practically what happens is, let's say there is a citizen who visited US for some trip in 2022. What he does is he swipes his credit card, incorporates a company, and comes back to India. Later, let's say in 2025, he wants to remit the capital or to start the operations. Now, when he reaches banker to make this ODI transaction, banks will treat this MOI subscription as the financial commitment date, because financial commitment can be fund-based or non-fund-based. In this case, you will have the Form FC to be filed twice. One is at the initial financial commitment date, and second is the present date when the remittance is being made. Generally, for OPI investors, like resident corporates or trustees investing in foreign mutual funds, reporting is to be done semi-annually, which is 60 days from the half year end, March or September, as the case may be. ESOPs or employee stock options issued by foreign parents are often missed. These must be reported by the Indian branch, office, or wholly owned subsidiary of the foreign entity which is there. Similar timelines as with respect to the OPI investor. Now, let us look at what is the annual filings which are there with respect to the annual performance report. Now, who should file this form? ODI investors which are holding more than 10%, more than or equal to 10% of holding or control. Due date is 31st of December annually. In cases where the foreign entity follows calendar year end as their closing date, then it will be the next year, 31st December. So for example, if the ODI is made in the calendar year 2024, which is ending on 31st December 24, the first APR will be due for that period by 31st December 25. Let us look at certain points where this APR is not required to file. So if the holding is below 10% without control and there are no other financial commitments except equity, or the foreign entity is under liquidation, then this APR is not required. Certain clarifications with respect to the ODI filing, APR filing. If let's say there are multiple Indian investors who are holding ODI in the same foreign entity, then the person who is holding the highest stake will file the APR. If let's say there are multiple investors holding equally, then they'll have to file jointly. Third, this APR needs to be based upon the audited financials of a foreign entity. Now, in case audited financials are not required, if the host country does not mandate audit, then only if the investor doesn't have control, then the audited financials are not required. Otherwise, audit is mandatory if the resident has control. Banks are insisting on this audited financials. Let us look at certain key disclosures in APR. We'll start first is the capital structure as on the year end, wherein details of any shareholding change during the year needs to be reported. Also, then you have profit, dividend, and net worth of 2 financial years to be reported to bring in consistency and continuity in the financial reporting. Then you have the repatriation section, wherein if any dividends, loan repayments that have been made during the reporting period, that needs to be reported, or any non-equity based proceedings that have been received, such as royalties, technical consultancy or technical fees that have been received during that period. Then we have certain specific disclosures for step down subsidiaries. Details of each step down subsidiaries, their details, their level, and the country of the SDS needs to be provided. Name and details of the parent entity needs to be provided. Investment activity code and shareholding, which is there in the step down subsidiary, needs to be provided. Then let us move to a topic which is which was earlier taken up by Prashant with respect to LSF, wherein he mentioned that there is a three-year window. So the 3-year window has triggered based on the OI regulations which have come in August 2022, wherein it is mentioned that any past delays or filings which are there in terms of APR, FLA, OPI, or share certificate submissions, the late submission fee payable will be 7,500 flat. This is with respect to any filings or procedural aspects that are there. Now, if there is any reporting that is missed out, then it is 7.5 plus a percentage of the amount that is invested multiplied by the number of years. Now, to regularize this, the time limits which I mentioned earlier, 3 years from the due date of event, it's already lapsed, or it is 3 years from the new regulations which have come in August 22. For all the legacy delays before that, the provisions have come in, which will end on 21st August 25. How do I regularize it? You need to apply to the AD bank with the explanation and proof for the delays which are there in terms of the APR filing. Second, AD bank will submit the proposal to RBI. RBI will issue LSF advice for payment. Once the payment is made within 30 days, the delay gets regularized. Now, there is a regulation called Regulation 12 in the ODI regulations 2022, wherein it is talking about if there are any filings which are delayed and defaulted, there are certain serious restrictions which are there in the regulation which are issued. Now, what is prohibited if there is a reported delay filing? No. Further financial commitment will be blocked. If, let's say, there is an earlier financial commitment in the same foreign entity which is not reported, then further financial commitment in that same entity will be blocked. Transfer of existing investment. If there is any delay in the reporting which is there, the transfer of existing investment will be held upon. outward remittances by ED Bank. If there is any delays which have not been regularized, then any outward remittances toward the same entity will be holded by the ED Bank. Note that these all apply to the concerned foreign entity which is under default and not to all ODIs which are there made by the individual. What are the takeaways? You must clear all the old filings, legacy filings which are pending before you make any new investment, or look at restructuring or disinvestment. All the UN numbers with wherever default is there will be freezed by the ED Bank. With this, we come to the end of the presentation. We can take up certain questions here, and then I can walk you through the Form FC with the details which are required to be filled in at the time of making any investment.
Yes, sir. So the question is whether NRI directors giving loans to the Indian company on non-repatriation basis, any complaints to be done under FEMA or RBI or any other regulations? Question is raised by Ashok Gowda.
Raman, you want me to take it up?
Yeah, please. If I heard it right, it was loan, not investment.
Yes, loan.
Okay.
Shall I go ahead, Raman?
Yeah, please.
So under the, again, it's not the topic of discussion today, but I can take it up. So under the FEMA regulations, NRIs can give loan to the Indian companies, but there are conditions. So you have to go and read those conditions. So these regulations are called deposit regulations under FEMA. So those regulations have to be followed. There are 2-3 conditions. One, what is the interest rate which can be paid is mentioned in the regulations. Second, what should be the tenure, that is also mentioned. And for what purpose this money has to be used is also regulated. So the deposit regulations under FEMA have to be read to basically to get the conditions and then follow them. So this will be regulated under FEMA, and deposit regulations have to be reviewed.
Okay. Next question is whether NRI invest in private limited company through NRI account, can it fall under FDI? Whether FCGPR is applicable?
This is already answered.
We have discussed earlier.
Can a resident individual create a firm in UAE for the purpose of forex trading that which have restrictions in India? UAE does allow such firm dealing in financial services in the economic zones. Question is raised by C.S. Shruti Vedula.
You want to take it up, Raman?
See, I feel the country regulations needs to be looked into, but at the same time, as we discussed earlier, if something is not being permitted directly, would not be permitted indirectly also. Sector specific regulations needs to be looked into for the trading and all. I feel it may not be allowed.
Okay, sir. The next question is whether FCTRS is applicable when share transfer from resident to NRI and NRI is transferring amount from his NRI account.
Yeah, so this is fairly easy.
Starting.
Yeah. So if the investment was done on, India, I'm assuming that there is an Indian resident and he is selling his shares to a non-resident Indian who is transferring the money from NRO account on a non-repatriation basis. So as I previously mentioned, FDI regulations will not apply and FCTRs need not be filed in this case.
So there is a distinction to be made here, whether the investment is on a non-repatriation basis or a repatriation basis. Accordingly, the provisions of valuation and FDI will come into picture. The same distinction between repatriation versus non-repatriation needs to be looked into.
Okay. So the next question is We have not allotted shares or refund the money within the specified timeline. As you discussed here, we need to approach RBI for approval. Is there any forms or by what means we need to approach?
It will be through your authorized dealer. So whoever is your authorized dealer who got this remittance from abroad will be the guy who has to process this through RBI. So you have to file a plain paper application with authorized dealer. He will get it processed with RBI and give you the approval.
Yes, sir. The next question is, what is the difference between an entity user and a business user?
The entity user is something where we are trying to create a master for the entity. It will be like a something you can equate it like a PAN or something like that. Business user is something where we are trying to create a login for filing the forms. So business users can be multiple. You can have multiple users wherein the master data is coming from the similar entity based on SIN. Once that is approved by RBI, then you are moving to the business user for filing the forms which are there.
Okay, sir. The next question is, in indirect foreign investment, a foreign company, first level DI company, next level DI company is the next level DI entity, which is also required to obtain an annual certificate from a statutory auditor.
There are 3 steps. I hope I got the question right.
Correct, 3 steps. ABC.
Unless we look at the structure once, it'll be easier to answer them. We can take it up offline later.
Okay. Can we revise the APR form, or and if yes, what is the time limit?
Revised APR can be filed, but we'll have to justify the reasons for the revision that we are making. So it is better to get in touch with AD Bank to understand the revision that is being looked at. Generally, there is a lot of diligence that the AD banks take up when they are approving the APR. Because we have seen cases where simple questions with respect to why the foreign entity is into losses. Because the provision says the investment needs to be made in an operating entity. So because it is mentioned as operating entity, they feel that the other entity needs to be in profit only. But that cannot be the case every time. Those kind of justifications needs to be provided. So I feel because of those justifications that the banker is looking at, revision may not be required. But in case if you have missed out on a particular important detail, then it's always better to get in touch with AD Bank to understand the next course of action on this.
What is the timeline for APR revision return?
See, timeline as such, I guess it's not provided anywhere. Prashant, you have any thought on that?
I didn't get the question. What's the question?
So APR is not filed, or let's say is filed with an AD bank, and later there is a revision required in that APR which is submitted.
That's okay. So there are 2 legs to this. One, if your APR is not filed within the specified timeline, then you need to pay the late filing fee, LSF.
Correct.
Second, until the APR is taken on record, you can't do any subsequent ODI transactions.
Right. The question is, what is there any time limit for the revision of APR?
No, there's no time limit. This scenario is not covered under FEMA. But if you want to revise it, then there has to be a logical reason. And this will go to the AD, and AD will have to again go back and take specific approval from RBI. So at the time of taking specific approval from RBI for revision, RBI would need to be given proper justification. As long as you're able to give proper justification, then it's fine.
Right.
Sir, the next question is, I'm an Indian company, private limited, want to set up a company in UK with one individual who is UK citizen, Indian origin but Britain citizen with 90-10 equity. This will fall under ODI regulations. It is not WOS, right?
No, if I understood correctly, there is a company being created with 90% holding of a foreign individual and 10% of Indian person. Is that correct?
Correct, sir. Correct.
Can you once again repeat that part just to ensure that we have got it correctly?
I'm an Indian company, 90% Indian company, want to set up a company in UK with one individual who is UK citizen. This will fall under ODI regulations. It is not WOS, right?
Okay. See, Indian origin but British citizen needs to be looked into if the provisions pertaining to the control are being met. If yes, then we'll have to look at whether it is falling under ODI or OPI.
Okay. The next question is,
yeah.
Sir?
Go ahead.
We are a private limited company in Hyderabad. We have only owner subsidiary in Australia who paid certain expenses, salary of employee of Australian entity of our Australian entity from Hyderabad entity. Should we regularize this transaction? If yes, how?
Indian entity paid certain expenses of Australian entity.
From Hyderabad entity.
So see, basically now when you say you paid expenses, whether you paid that in India, I'm assuming that you paid that in India and that sits in your balance sheet as liability. And that liability is towards the foreign company. That itself is a violation because you cannot incur a liability on behalf of a foreign company. So in case if you have done this, then there are two ways to regularize this. One, you have to create a liability for that in the books. Then you have to either get the payment from the foreign company, or I don't know whether you want to issue these, you want to issue shares of your company and capitalize the liability. Whatever you want to do, possible. But first, you have to go and compound the offense with RBI if you create liability in your books, because you are not supposed to create a liability on behalf of a foreign company. But if you have already done, then you have to go and first file an application to the RBI, then pay penalty in terms of MR regulations for violation of the FDI regulations, and then you can basically do whatever you want. Whether you want to get the money from abroad, you can get the money from abroad. If you want to issue shares on your company to the foreign company guy, you can capitalize that liability through issuance of shares by taking a specific approval from RBI.
Thank you, sir. All questions are completed. As we come to the close of today's session on cross-border transactions and FEMA compliance, it is my privilege to extend a heartfelt vote of thanks on behalf of all the participants. First and foremost, I would like to express our sincere gratitude to Mr. Prashant Jain and Mr. Raman Heda for sharing their deep insight, practical experience from basics, definition to form filing and expert guidance on everything you have told. Your valuable inputs have truly enriched our understanding of a complex and evolving area of law and finance. I also thank our organizing team for putting this session together so seamlessly, and of course, all the participants for your time, attention, and thoughtful engagement throughout. We hope today's session has been informative and thought-provoking, and we look forward to more such enriching discussions in the future. Thank you, sir. Thank you all, and have a great evening ahead.
Thank you. Thanks, everyone.
Thank you.
Thank you.